How to avoid catching a falling knife with bottom fishing made easier. Let me put a couple of ideas out there that should help improve your odds with this. First is these should be limited to no more than 20% of your overall trading efforts or trading attempts. Overall, you should be trading with the trend, either shorting breakdowns or going long on breakouts to the upside. This is a difficult discipline issue for many of us, but it's very important to remember. Having said that, here's some of the things that we want to look at for how to correctly bottom fish. Again, you want to look for multiple point fast drops. Don't try and go long into a steady downtrend. That's not the way to trade. For reversals, you want to be able to look at potential upside on a volume reversal following a sharp multiple point drop after an uptrend's been established. Here's an example, Amgen. It's sold off all day long. You get some end-of-day short covering around 340. That's a common reversal time to look at. If a stock's been selling off all day, you'll see some short covering and a pop towards the end of the day on some of the days. And this is exactly what happened in Amgen. You can see it sold off down to 61.2, made a bounce here. We wouldn't try to buy the stock down here. I'd wait till it's over the 0.4 or 0.5 above the whole number to give us some strength, and make sure that that's accompanied by a volume spike. And you can see this volume reversal in Amgen. Here's another example, Biogen. Same thing, and also these tend to move in sectors too, so if you see one stock in a sector starting to make a bounce after a sharp drop, you might want to look at other stocks in the same sector. This is our biotech sector. So first was Amgen, and here's Biogen, BGEN, another good one in that sector to day trade. Same exact pattern. Sold off sharply from 58.2 down to 56.2. That's a nice 2-point drop in just about an hour's time. The way we look for an entry on this again is at, say, the 0.4 or 0.5 over the bottom after an uptrend's been established and a confirmation seen with increasing volume on the trade. Let's look at one more example from that sector, HGSI, another biotech. In this case, you see a double bottom. Now, normally, we look at losing, this is a 2-day chart, using the loss of the 2-day low as a short entry, and that would be the right case. Here, say 49.5, 49.6, something like that on a short. For a long, if you're looking to catch a bounce, again, you want to wait till it's at least at, I like to use, like I say, 0.4 or 0.5 is the threshold, the confirmation that the stock's not just grinding down and continuing getting sellers. For long trades, you want to wait till it's over 0.4, 0.5, and again, limit these to after multiple point drops. And in general, trying to catch bounces is much lower percentage trading than simply trading with the trend, but you can identify occasional opportunities where you can make a quick half point or 3/4 or so on a bounce for stocks that are making, a Fibonacci retracement bounce after multiple point drop. Let's take a look at a second set here. One of the points, chart patterns for bounce play, spotting when a pivot starts. One of the things that we want to look at is the first early sign. Typically, if you see a very sharp drop like this is an Adobe two-day chart. Here's what it looks like intraday on our 1-minute candlestick. Is sold off, paused here right before 10, got a reversal, bounced, started consolidating here from 10 to 11, really didn't get much buying until after 11 o'clock, and then it was up to the Fibonacci retrace level. Again, this is roughly half of our total range, a half to a third, the range, and this is the maximum you can expect on a bounce. Again, an entry on this would be, say, 37.5 or so. And, even these are relatively iffy because you might have entered here and then gotten stopped out here and then tried to enter again here and only gotten a small trade, that kind of thing. So for your bounce trades, you want to make sure that you're entering relatively quickly after a sharp multiple point drop in the stock. You don't want to just buy into an overall downtrend, just like you don't want to short into an uptrend. You only want to look for these as being the exceptional trades following a sharp drop in the stock. So I'm only going to try and bottom fish if I see a very sharp slope like this, the line where it's dropped very quickly and starting to bounce. Same thing on shorting tops. Those are low percentage, you want to avoid those, but if it's shot up 2-3 points and is starting to fade, then you might want to fire off a short. And let's take a look here. A couple more examples. Merck. If you're looking at volume reversal patterns and stochastic bounces, again, stochastics are I use a 15 period on those, by the way. Stochastic bounces are for occasional confirmations. The type of thing we're looking for here, let's take a look back at Adobe here. If you look at that, you can see it's coming back over the 20% down here, and that's corresponds to a bottom, starting to get a lift here, and this is telling you to get out as it's starting to lose the 80%, and that does correctly define the range for the bounce in this stock. If we apply that to Amgen, you can see here you have an example of a false bounce here over the 20%. Here's one that did follow through a bit later. So again, stochastic's a secondary indicator. Use those to help time your bounces. Overall, what I like to see is a volume bounce like this. You can see a large volume spike here, and you can see increasing volume on the way up. And so volume confirmation helps in terms of correctly identifying your reversal patterns and bounces. And also, like I had mentioned in the earlier section, look for candlestick dojis. If you see a small plus or a bullish engulfing pattern on the upside, that can also help correctly identify the entry on a bounce trade.